us today. And we are grateful for the distinction he lends to this. I speak today in the presence of eminent economists, the members of family of Sri Ramachandran, and also the students of economics. I do so not as a professional economist, but as a career banker and a banking supervisor. So my perspective is therefore that of a practitioner. I have great respect for economic theory. I have even greater respect for what happens when theory meets reality. The subject on which I wish to speak today is on learning, judgment, and supervision. Lessons from my own banking career. So my core theme is that banking cannot be understood only through numbers, models, or regulations, though all three are important. It must also be understood through experience, institutional behavior, and the public purpose that finance is meant to serve. In that sense, a life in banking has offered me three educations: the education of the classroom, the education of the banking counter, and the education of supervision. Each offers a different lens, and together they have helped me understand banking more comprehensively. It is this experience that I would like to share, especially with the students gathered here today. So let me begin with the classroom. Economics first came to me through examination papers, like many of you would have encountered, through examination papers in school and college. The themes were in many ways evergreen: demand and supply, money and banking, public finance, international trade, national income, and business cycles. These are the most familiar themes all of us had. Like many students, I understood them well enough to write and clear examinations, but I do not think at that stage I fully appreciated how deeply they would later shape my understanding of banking and finance. It was only when I entered banking that many of these ideas acquired life. Demand and supply were no longer only curves in a textbook. They could be seen in the appetite for credit, in the pricing of funds, and in the behavior of our borrowers. Money and banking, which had once been a paper in the curriculum, became the world in which I worked every day. That is why I say, with the benefit of hindsight, that a good education in economics is a powerful thing. It teaches you to ask questions that are simple in form but deep in consequence. What are the incentives? Who bears the cost? Who receives the benefit? What happens if a rule changes? What are the unintended consequences, and these options as compared to what? So take banking. The bank is not merely a building, not a balance sheet, not an app on your phone, as several of the current generation will believe that the bank is an app. It is an app, but then it is not just that. A bank is, as I see it, a bank is a bundle of promises. It promises depositors that their money will be safe and available when needed. It promises borrowers that the credit will be available on fair terms. It promises shareholders that capital will be safe. It promises the regulator that it will conduct itself prudently. Finally, in a country like India, banks also carry a broader developmental expectation to support inclusive economic growth. So economics helps us understand these promises better. It gives us concepts such as moral hazard, adverse selection, information asymmetry, and systemic risk. These are not merely academic expressions. They are everyday realities in banking. Moral hazard appears when an institution takes excessive risk because it believes someone else will bear the consequences. Adverse selection occurs when a lender, unable to fully distinguish between a good and bad risk, ends up attracting weaker asset quality. Information asymmetry creeps in when the bank does not get to know the true financial position of the borrower. Systemic risk can arise when the failure of one institution damages public confidence in many others. The classroom gives us the language to understand these realities. Practice teaches us how they appear in real life. The financial system is not made up of variables alone. It is shaped by people, institutions, incentives, habits, cultures, memories, and fears, and at times greed. That is why the classroom, valuable as it is, must be complemented by experience. So this brings me to the second education, which is the banking counter. For many bankers of my generation, banking began at a branch. Customers at the counter, vouchers of various colors and hues, ledgers, cash books, loan applications in paper files, site visits, and credit proposals that had to be examined not as classroom exercise or not on a computer, but in actual practice. It was also a period when banking was beginning to change. As I was mentioning to Dr. in the morning, the recommendations of Dr. Rangarajan's committee, or rather two of them, helped usher in the early phase of bank computerization. And ALPMs, many of you may not be familiar with that terminology today, the current generation. The ALPMs became one of the visible symbols of that transition. But my subject today is not computerization. We will reserve that for another day. It's about something more basic and perhaps more enduring. The first lesson one learns in banking is that it is not only about money, accounting, or procedures. It's about judgment. Credit is a judgment about the future, for example. Will this borrower repay? Will this business generate the cash flows it has projected? Is the collateral worth what it is claimed to be? Is the promoter being realistic, optimistic, or overexpansive? These questions cannot be answered with certainty as the risks appear from the way the borrower presents his accounts, in the assumptions behind a project, in the enthusiasm of a relationship manager. They require analysis, but also a gut feel for people, market, and institutions. After seeing enough loan proposals, borrower meetings, and credit committee discussions, one notices the signals. A business that is profitable on paper but constantly short of cash, a borrower who explains everyday delay as temporary, a credit proposal that relies more on collateral than on cash flows, a loan book that grows faster than the bank can monitor, each tells you something. None of these signals is proof by itself, but each is a prompt to pause, ask better questions, and look deeper. The counter teaches you the difference between the presentation and reality. The audited balance sheet and information memorandums are useful, but they are not the business. The business is in the factory, on the shop floor, in the market, in the supply chain, in the quality of management, and the decisions taken every day. The banker's job is therefore not to be cynical, but to be curious. This is where one begins to appreciate the art as much as the science of economics and banking. Numbers, ratios, and models are essential. They impose discipline, allow comparison, and protect us from relying only on instinct. But they do not interpret themselves. Unlike an exact science, banking deals with people, firms, institutions, and uncertainty. A current ratio may tell us something about liquidity, but not everything about the borrower's ability to manage stress. A debt-equity ratio may tell us something about leverage, but not everything about the quality of management. A repayment track record may tell us something about the past conduct, but not always enough about the future resilience of the entity. This is an important lesson for students of economics. Institutions and firms cannot be understood only through reported numbers. Numbers tell a story, but one must learn to ask what lies behind them. Whether profits are supported by cash flows, whether growth is supported by capability, whether risk is understood or hiding in plain sight, or whether governance is a living practice or only a formal structure. The counter also teaches us the human dimensions of finance. Behind every loan account is not only a borrower but a story. Sometimes it's a story of genuine business difficulty, a sound enterprise affected by a shock beyond its control. Sometimes it is a story of poor judgment, expansion undertaken too quickly or a debt taken too easily, or risks underestimated during good times. Sometimes, of course, it's a story of deliberate misconduct. A banker must learn to distinguish between these situations, not because the discipline of repayment is less important, but a banker must learn to distinguish because understanding the cause will help one respond better. The education of the counter is invaluable. It gives the banker experience, instinct, and feel for the risk. But a banker usually looks at risk from a perspective of their own institution. The supervisor must view the same institution from a systems perspective. That shift in perspective brings us to the third education that I want to speak today, the education of supervision and public practice. When one moves to supervision, the viewpoint changes. A banker is naturally concerned with growth, profitability, customer relationship, and competitive position. A supervisor is concerned with safety, soundness, governance, and the larger public interest. This does not mean that the supervisor is indifferent to the difficulties of running a bank. On the contrary, a good supervision requires an appreciation of those difficulties.
Members of the Ramachandran family, faculty, students, and staff. I'm indeed very happy to be with you all this morning on the occasion of the 12th G. Ramachandran Memorial Lecture. Mr. Ramachandran was an outstanding administrator. He had a brilliant academic record, followed by topping the IAS exam. I was also a student of my own college, but I didn't get to know him because he was several years ahead of me. But he was a role model for all students at that time. As a distinguished administrator, he had the opportunity to hold key positions, both at the state level and at the center. This gave him an opportunity to give shape to critical economic policies that India needed in those days. What is the role of an administrator? A good administrator is one who places before the political leadership, which has to take the decision, the pros and cons of every problem that comes before it, and lay out the alternatives before the political leadership. It is often said by some that the members of the Indian Administrative Service are all cautious. But it is also said not only about IAS people, but the entire government service, that they are all trained to do what? As they say, to do things rightly rather than do right things. That is a real problem. A good administrator must be a thinking administrator. An administrator who can, as I said earlier, look at alternatives and make the right suggestion. I think it was fortunate that we had distinguished administrators like the Ramachandran. And I would also say that I had no opportunity to know him that well. But as was mentioned by Ganapati, when I was governor of the Reserve Bank, he was nominated as member on the board of directors. And he came to the board meetings always fully led and with all alternatives and insights on the problems that were coming up before the board. Therefore, the members of the board looked forward to what his comments were going to be. And that is an important contribution that he made post-retirement to the development of the country. G. Ramachandran completes 99 years with this year. The next year is going to be very significant. It will be a centenary a year. And we will discuss with Mr. Ganapati and his family members as to how to deal, what to do with it. I'm also extremely happy that Mr. Swaminathan accepted an invitation to deliver the memorial lecture today. I have also not known him that well, but I read his lectures, which are printed in the RBI. I must tell you, these lectures usually are not that lengthy, but they are crisp, and I would say the simplicity of the style is very attractive.